Gautam Duggad is with us, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, welcome to the program. Good morning. Thanks very much. Prashant this side. Let's just start with what we've been talking about since last Friday, which is consumption, FMCG, but consumption broadly. And many have been sort of on the sell side pushing this theme, but it's not worked yet. Maybe it worked yesterday. It's been fleeting, to put it mildly. What is your sense? There are lots of factors aligning, and I think we know all of them. Perhaps this GST rate realignment, that 12% slab perhaps will also help along with everything else. But what is your view? Will this part of the market make one money? And where exactly?
Hi, Prashant. Good morning. Thanks for having me. So when you talk about consumption, it subsumes so many sub-segments that it's very difficult to take all of them and paint them with one brush. So what has been happening over the last few years is that the low-ticket consumer staples has been struggling. And they've been struggling for last 3, 5, 10 years, not a recent phenomenon. Of course, it got broadcasted more recently. But if you look at the last 10-year compounded sales growth of many of these consumer staple names, hardly one company or two company at max, if you stretch, would have done a 10% top line CAGR. And I'm talking about top line, not even volumes, right? So, and of course, the last 3, 5 years have been very, very tepid. In fact, I won't be surprised if there are many stocks you will find which would have given zero returns on a 5-year basis. In fact, the bellwether stocks have done nothing. So what has actually happened is, within the consumption space, the higher ticket discretionary goods, they've done far well. And which is where our stance has been for last 4 years now. And we are continuing with that stance. In fact, yesterday when we published our strategy preview for this quarter, we've made consumer staple weight 0 in our model portfolio. We had a single stock as it is, that also we've removed. So all our consumption allocation in the model portfolio now resides in discretionary. We feel as we move from $2,800 per capita to somewhere close to $3,500, $4,000 over the next 4 to 5 years, the alpha that you will generate in consumer discretionary stocks will be far better than consumer staples. In fact, consumer staples volume growth, there can be some episodes of few quarters where the volumes might go up to 3% or 4, 5% here or there. But from a slightly longer term perspective, I think the alpha and the absolute returns that you can generate in discretionary will far outweigh what you will get in staples. Having said that, staples will obviously provide downside support in a volatile market when market is in a corrective phase. But I don't think we are building portfolios for those kind of markets. So our stance remains intact. We prefer consumer discretionary or consumer staples.
Got that. Gautam, hi, morning, great to have you on. I remember that in your model portfolio, I think Titan is a stock that you've liked for a long, long time, right? Yeah. Now, when we talk discretionary consumption, even there, the market is hungry for growth. And say, for instance, I mean, if you just talk about the jewelry space, there are other companies, smaller companies like Kalyan and Senco. They're managing to grow at 25 or 30%, but Titan, I mean, at least this quarter, they're talking 18%. So what is happening with this industry bellwether? Is it just a temporary sort of realignment of sorts? Because the market's mood changes very quickly. And we're seeing some of that play out this morning itself, that they're hungry for growth, they might as well go for tier 2 jewelry stocks. What would your advice be to investors in this sort of situation? Trent is another classic example, right? Great company, great pedigree, but from a 50% growth rate, now they're doing 20%. And we remember how badly the stock was punished. So how should investors think about some of these high pedigree, marquee leader stocks if the growth rate starts tapering down?
So Surabhi, just 2 points. On Titan, the size of Titan versus other jewelry players is 5 to 6x on revenues. And in some cases, even 10x maybe versus the smaller companies that you mentioned. So obviously, if those companies are growing at 25, 30%, Titan's 18% is very respectable on that size. Plus, also remember the fact that 1Q FY26 jewelry prices, gold prices versus 1Q FY25, the underlying gold price inflation itself is more than 30%. So clearly, there is going to be some impact on volume here or there. Third, the sector's size is $80 billion. And sector over the last 10, 15 years has been very consistently and gradually transitioning from unorganized to organized, which augurs very well for all the organized players. And of course, Titan being the bellwether leader of that industry will stand to benefit the most from it. the reason why we are positive on jewelry and not just Titan, some of the other names like PN Gargill, etc., is the fact that the size of the industry, the TAM, gives us confidence for a very long runway of growth visibility. Today also, organized is hardly 40 or 45%. And if you go by the demographics of India, which we discussed extensively in your last Friday's editors roundtable, we have a very young demographic where wedding will continue to happen. And out of the 650, 700 tons of annual demand of gold in India, around 55 to 60% is wedding. So this industry offers tremendous growth visibility, of course, with a lot of intermittent volatility, depending on how the underlying gold prices behave. So we remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to Trent, that is where we've had a tactical positioning change in our model portfolio now. We've replaced Trent with Jubilant Foodworks. As you rightly said, for a company which is trading at 110, 120p, there's absolutely no room for error. I mean, if you view it in isolation, 20% growth on top line for Trent looks very, very respectable compared to what the peers are printing right now for last 2-3 years. They're struggling to grow even at 8-10%. But the fact is, Trent trades at triple-digit PE. So expectations embedded in that stock price were of 25 to 30% top line growth on a minimum, right? So therefore, 20% growth will look like a dampener vis-a-vis the valuation that it is commanding. So we think that it will take a couple of quarters, and more importantly, not just the growth. We were a little bit surprised by the store additions for the quarter. Maybe there's going to be a bunch up, and obviously, whatever the annual targets are, they generally don't tend to be linear, more non-linear in nature. So story remains very intact. If I were to take a call on 3 years, there is absolutely no doubt that Trent will form a very respectable allocation in my portfolio. But from a near-term tactical 3 to 6 months perspective, we think there's going to be more time correction that is that Trent might see.
Interesting. So, Trent makes way for Jubilant Foodworks. That's quite interesting. Sorry, 10 seconds. I'm taking from Nigel's time, but just 10 seconds. So, Jubilant Foodworks, I mean, QSR, is that the only stock, or overall have you turned very positive on QSR? Quick 10 seconds, and we need to move on to other sectors.
So QSR has a very favorable base, plus incrementally, we think urban consumption is about to revive for a variety of factors that you already mentioned. And that's why Jubilant, being the only company with great market share, excellent delivery on cash flow, and a strong balance sheet, we think it's a small sector ultimately. You can't have too many stocks of QSR space in the model portfolio. So we chose the best one that we thought.
All right. Hi, Gautam. Good morning. Good to see you. And as always, let's talk about earnings then. Earnings season is going to be upon us in the next few days. Results will start trickling in. Q4 was great, actually, because expectations were so weak and then muted. And then suddenly, in fact, it looked better than expected. This time around, in terms of earnings growth, what are we factoring in? And for the year, what are you looking at in terms of Nifty EPS growth?
Good morning, Nigel. So yes, you rightly said, fourth quarter was the best quarter of last year in an otherwise very tepid full year FY25, which turned out flattish after 4 years of 20% plus earnings compounding in Nifty and close to 30% earnings compounding in Nifty 500. This year is looking much better compared to FY25 for a variety of factors. Government, RBI, a lot of things have come together and they've given a lot of pro-growth measures, be it rate cut, liquidity, income tax cut, monsoon is good. So we think FY26 earnings will be far better. We are working with an assumption of close to 11-12% earnings growth for full year. To begin with this quarter, we are expecting 10% earnings growth for our coverage universe and about 5% for Nifty, which essentially means that as we progress into the subsequent quarters, and because we always prepare 4-quarter breakup right at the beginning of the year, the next 3 quarters we are building in about 13, 15, and 16% growth for our coverage and 6, 12, and 15% for Nifty. So as we progress further in FY26, I think the news flow around earnings will turn far better. Second, a lot of sectors are contributing. Last few years, we have gotten used to few sectors driving the growth. The interesting thing in FY26 and more particularly for 1Q FY26 is that the smaller sectors, which have hitherto not contributed much to the earnings growth, they are joining the party. So sectors like cement, sectors like retail, they are coming and printing more than 20% kind of earnings growth this quarter. Whereas the bigger sectors, auto, BFSI, IT, pharma, consumer durables, they're still struggling in that 4 to 8% kind of growth band right now. We expect financials to become far better as we progress in second half. The benefit of rate cut and surplus liquidity will start manifesting in their numbers from second half. So net about 10% earnings growth to begin with for this quarter for our coverage universe.
Talk about some 50% upside stocks, Gautam.
And 25%.
And by the way, I'm not joking. I'm serious.
So I'll give you an option: either stocks with 50% upside or stocks with 25% earnings growth. I'm making it very simple for him, right?
Absolutely. So I'll choose Surabhi's question then. That's far easier. 50% upside stocks generally, Prashant, are known in hindsight. Just like
no. You give us 25% earnings stories, they'll give us 50%.
Absolutely. That's why I've chosen the easier path. Look, there are sectors like cement, EMS, where we are expecting very strong growth this particular year. Cement has struggled for last 2 years, and we are expecting pricing to improve, EBITDA per ton to grow 30% this quarter. While stocks may not have corrected much in FY 24-25, despite very tepid earnings, but as you start seeing print of better earnings there, and of course, the underlying macro on consumption, capex spending by government has also given a bit of a hope. If you looked at the March and April number of government capex data, so cement clearly looks like a good bet. Second, EMS, there we are continuing to see not 25% but 50-60% earnings growth. Very difficult to find this kind of stocks in other sectors given the environment that we are living in. So if you look at it from a very top-down perspective, Prashant and Surabhi, we are slowly transitioning into an era where the nominal GDP growth itself will settle at 9-10% band now. Because you've gotten a control over inflation. We are talking about 3.5-4% inflation and roughly 6.5% GDP growth. So nominal GDP, if it settles in 9-10% band, very difficult for corporate India to print more than 12-13% earnings growth in this kind of a environment. With that, of course, there will be a lot of stocks which will compound at 20-25%. There are stocks in retail sector where we are seeing more than 25% earnings growth for FY26. Then there are some pharma names, some consumer discretionary names, obviously, that we discussed about. So there are many stories out there for bottom-up stock picker and asset allocators to find that.
You mentioned Jubilant Food, Gautam, out of the, just completely published, nothing non-published, out of cement, EMS, etc. Which are those names?
So for example, in EMS, we are very hot on Dixon and Kate. Both are there in our model portfolio. So they have benchmark 0 allocation in the benchmark indices. We have 4% allocation, right? In discretionary, as I was discussing with Surabhi a few minutes back, we have Titan, we have Indian Hotel. They've been part of our model portfolio for many years now. We have Page, and we've added Radico Khaitan. Again, very strong earnings growth there. Last 5 years, they've compounded earnings at 35%. Next 3 years, we are expecting 25% plus earnings CAGR. That finds entry in our model portfolio. And of course, we have Page also. So there are a variety of names. In fact, Prashant, while at it, I must also mention that we have increased the weight on mid-caps after a long time in our model portfolio. So till April, we had 76% allocation to large cap. We have brought it down to 69% because the mid-cap earnings are looking very strong. Last quarter, our mid-cap portfolio of 93 stocks delivered 26% earnings growth or 22% earnings growth. This quarter, again, we are expecting 21%. And as we progress for the rest of the 3 quarters, our expectation are 10, 25, and 20%. So mid-cap earnings are outperforming large cap by a margin of 2x. And therefore, while we keep debating on valuations, and valuation premium is there, everyone can see it, and it's been there for more than 3 years now. If this kind of growth continues, it's very difficult to imagine that that premium will.
And what are the new additions on the mid-cap side, Gautam?
So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Lodha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto, like we discussed a few months back. That auto is offering you a combination of reasonable valuations and modest expectations. So while we have not changed our stocks in auto, we've increased the weight on both M&M and TVS, which were already part of the model portfolio. But auto moves from underweight to equal weight now.
Very interesting. So auto moves from underweight to equal weight. And that's largely because of your focus on auto ancillaries, or just expand on that? Because again, auto, for the longest time, like FMCG, has just failed to enthuse. FMCG, you're not changing your stance. You've explained that. Within auto, what are you turning positive on now?
So auto, we already had M&M and TVS in our model portfolio for some time now. M&M,
which have already done well, Gautam. But anything new?
We expect it to do better now. In fact, this quarter also, if you go into the details, you will find that out of the 26 auto stocks that we are covering, the two best performers for this quarter in terms of earnings growth will again be M&M and TVS. Rest of the stocks, Maruti, Hyundai, Tata Motors, Bajaj Auto, they will print a negative earnings growth again in this quarter. Right. So we are quite lucky to have chosen the right stocks, even when we were underweight on the sector. So you're not changing the stock calls per se. Insofar as auto anchors are concerned, we think Craftsman, Endurance, and Happy Forging are the names where we have a slightly positive bias. But the change in stance in auto is primarily dictated by top-down trends, where valuations are still reasonable, expectations are modest, and underlying trends on monsoon, income tax cut, inflation, all of them are giving a signal that at some point of time in next 1 or 2 quarters, things will start looking better for auto. So we are positioning for that.
Very quickly, Gautam, no conversation on the market can be complete without discussing defense, right? And the next company that we'll be speaking to is Astra Microwave from that sector. So just very quickly, your thoughts. Prices have run up, but the order books are coming. Big order announcements are still coming. What's your advice to investors on defense?
We continue to like it. In fact, we've added Bharat Electronics now in the model portfolio in place of ABB. We also like Hindustan Aeronautics. The problem, however, is the stocks have run up too fast. What was our target price when we initiated HAL in March for 12 months was achieved in 1 month. In fact, as we keep highlighting this, the total market cap of defense went up from somewhere about 1 to 9 lakh crores in a matter of 3 years. July 24 was the peak. Between July 24 and February 25, it came down by 35%. And then between February and June itself, it recouped all its losses and crossed the all-time high market cap. Right. So opportunity is tremendous. The focus of the government is there, and kind of geopolitical turmoil that we are seeing in the world. This sector will definitely merit attention. Just that one has to be patient and shouldn't expect a quick buck here. So if one has a 1 to 3 year horizon, I think we can still make money here.
But long term, yeah, don't look at quick gains because that
valuations have gone up substantially over the past 3 years, and more so post Operation Sindoor and rest of the geopolitical events that we have seen unfolding in the last 3 months.
Absolutely. So a little bit of caution perhaps warranted. Great conversation this morning, Gautam. Thank you so much for joining in. So we are, all excited for the earnings season, and the expectations are that this is going to be a good one, and maybe we get out of that single-digit growth funk that the Indian market has been in FY25.